Hi and welcome everyone. Just going to give a couple of minutes for everyone to log in. Everyone does seem a lot of people are very punctual today, but let's just give a few minutes for anyone who's having some technical issues, because there's always something going on. And yeah, I'm going to mute myself. I'm going to probably wait for the people who are struggling to give me calls. Otherwise, I'll talk to you now.
Hi everyone, just to bring you up to speed, we're just waiting for the last of the registrants to log in, and then we'll start, I would say, roughly just on 5 past. So Milan is standing by, and we'll come back to you in 2 or 3 minutes. Thank you.
Yeah, hi Ren. Yeah, sorry, we're just being a bit quiet because we're waiting just to make sure everyone's getting in. But just can you just confirm you can hear us? I see a few people with hands up. I'm sure that means they all can hear. Just want to make sure Ren, who mentioned that he can't hear, can hear us. Perfect. All right. Well, Stan, do you want to maybe well, I think majority are here, so let's start, and do you want to do the introductions?
Yes, so hi everyone, welcome to the session on IFRS, IFRS or if not RS, I don't know if that's the way it goes, but we have today Milan van Wyk from University of Johannesburg. He's a lecturer, accounting, the CASA, and he's going to talk us through IFRS for SMEs today. Tomorrow, of course, is a general update. I've been researching anything, but I could only find jokes on COVID and on load shedding, so I don't think that's, you probably heard them all. So hopefully we don't have load shedding during the session, and look forward to an interesting session from Milan. So Milan, the floor is yours. We'll have a break at about halfway through, a body break, and then we'll go through. If there's any questions, please post them, and we'll deal with them in due course. Then you will monitor that. And I hope that everybody received notes, which was sent out about an hour ago, and a couple of hours ago. If you haven't, let us know, and we'll send you another set. Thanks very much. See you later.
Right, thank you, Stan. Thank you, Danny, for the introduction. So yeah, I'm ready for action today. Today's topic will be IFRS for SMEs. Just a general update on that. So I just want to double check everybody can hear me. Just want to make 100% sure before I get started. All right, so I think it's good. All right, and everybody can see the screen. Just want to confirm it. Just a yes, maybe in the chat or something. Okay. All right, so I'm just going to switch off my screen on my side. I don't like looking at myself while I'm talking, so you're just gonna see the screen, my voice. So welcome everybody. Like Danny and Stan said, I'm Milan van Wyk. I'm a chartered accountant. I work as a senior lecturer at the University of Johannesburg, and I've been working there for about 9 years now. So it's been a while. Do regular IFRS updates, IFRS for SME, IFRS updates. So yeah, I hope you guys enjoyed this. Yeah, like I mentioned, we're doing an IFRS update for the SME standard. And just want to quickly just talk about the background of the IFRS SME standard in terms of the updates. Okay, so for many of you, I assume all of you are reporting on IFRS for SMEs or want to maybe report on IFRS for SMEs. So just a quick update on that. So the standard itself was issued for the first time in 2009. And then, like the ISB said at the start, they want to go and do comprehensive reviews and updates as they go along. And it will be cyclical. And the first one that they have done in 2012. And after the 2012 review that they've done, they've published changes and amendments in 2015, which was then effective in 2017. Okay. And basically what happened since 2015 is that many standards have been issued and became effective on full IFRS. There was a new conceptual framework that has been issued by the ISB in 2018. You've got your IFRS 15 standard that changed the whole revenue recognition model. You have your IFRS 9 standard on financial instruments with a lot of new principles and new methods of calculating bad debts, like one would say in the old days. And then the leases standard also changing, and also quite recently they've issued a standard on insurance contracts, right? And but we're not covering that in detail today. But you know, a lot of movements has happened on the IFRS space, and that needs to obviously start to align with the SME standard then as well. So what is happening then basically is that sorry, I'm just going to get the spotlight here quickly. That they wanted the second comprehensive review that they've done in 2020, and COVID was a good time to do it with everything happening, and just to realign what they want to do with a particular standard. So the ISB is currently in the process of publishing a exposure draft, which is then expected to be published late this year. All right, so I don't expect it to be early in this year, so it will probably be October onwards. But at least there is some decisions that has been taken from agenda decisions on the working group for the SME standard. And what I will do is I'll go through those decisions that they've made. Obviously, it's not cast in stone yet, but it can give you a direction or an idea where the ISB will be going with the IFRS for SME standard. Right. So moving over to what we're going to cover today. So there are a couple of specific sections that we'll deal with where the most of the changes will be. There are a couple that we won't cover in detail today, and that's the one on employee benefits, the fair value measurement, and the scope amendments and alignment. So there are changes there, but very minimal. And the reason why I'm not going to cover those is that revenue is quite a significant change, section 23, that the ISB is proposing, and I will spend quite a lot of time on that particular element. So I think what we'll do is we'll break just before we get to get to the revenue standard, and then everybody will be fresh to listen and hear what is happening there. Right. So I'm going to go through them one by one. Obviously, starting off with the concepts and pervasive principles, section 2. So, what is the change? So, what changes can we expect to see on the concepts and principles? So, this particular section aligns with the section or the standard or the conceptual framework on the full IFRS model, and you know, the section itself should be aligning with the conceptual framework from IFRS, and that's why the ISB took the decision to say this. They're going to keep the section because it still provides those overarching principles, but what they're going to do is they're going to align it with the new conceptual framework of IFRS. So what's going to happen then is basically, for those that do know, is that IFRS, the new conceptual framework on IFRS, have new definitions on assets and liabilities and equity, and new concepts coming through. You know, and new guidance coming through that will be incorporated. Also, a big change would be the recognition criteria that's changed from IFRS. So they're moving away from probability and reliably estimate criteria and going more looking at the qualitative characteristics of relevance and faithful representation. And the same thing for measurement. So in the past, there wasn't a lot of guidance, conceptual guidance on measurement, which then also will be introduced with the ISB, with the IFRS for SME standard. So they will be giving guidance when you can measure at fair value or current value, when will historical cost basis be more appropriate, etc. So if you are developing accounting policies, that will be great guidance to have when you are dealing with very specific issues that no section in IFRS SME can deal with. Right, and there's also some guidance on presentation disclosure that we can also probably expect if they align this section with the conceptual framework. A nice thing is that they're going to keep the concept of undue cost and effort. And then, very important, they're going to include a statement to state that sections in the standard itself will take precedence over the concepts in section 2, which is similar to the conceptual framework, where it doesn't mean that all the standards will need to change, and you need to align with the conceptual framework. And again, the standards itself overrides the conceptual framework, and in this case, the SME sections in the SME standards will override the section 2. Right, so the definitions and those things that's defined in those sections will remain, and it will take precedence over section 2. Right, so that's basically it for the first one. And then the other big change, or not big change, another significant change that they have or proposed is on consolidated and separate financial statements. So the first one there is basically just to align the definition of control with IFRS 10 on the full IFRS standards. So there you can see that they say that control is the power to govern the, the old standard, the SME standard, mentioned that, the control is the power to govern the financial and operating policies of an entity to obtain the benefits from its activities. And that's basically the old IAS 27. If you think back on the old full IFRS standards, that's pretty much the definition there. But now they want to align with the new IFRS 10 definition, where it goes now in and saying the investor controls an investee when it's exposed or has rights to the variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. So there's a lot of similarities still there. So there's still power, there's still policies, but now they talk more about the relevant activities, and that you have the ability through the power that you have over those relevant activities that you can have control over a particular company. All right, so that's in terms of the definition. And then what they stand, I just want to highlight this. So the rebuttable presumption of paragraph 9.5 in the IFRS for SME standard, the section has been kept. All right, So they've updated a little bit just for some clarities, but again, that rebuttable presumption remains of, if there's a more than 50% voting rights, that you do control it and that you can rebut it based on other elements. But the presumption is that if you own more than 50% of the voting rights, that you do have control. Right. Then some more specific proposed changes. So if you look at step disposals that result in a loss of control. So if you've controlled a company and you sold, let's say, 30% of your shares, and now you end with 30% remaining interest in the company, you've lost control. And the question is now, how do you deal with the investment there? Okay, so what the old section said in the SME standard, or currently what it's saying, is that you will need to account for that remaining asset in accordance with section 11 or section 12. So basically as a financial instrument, where the carrying amount becomes the initial cost of that financial instrument. Okay, if it's not jointly controlled or an associate. Okay, but now the new proposed change would mean that they would change that and say that if you have any retaining interest, you need to go and measure that at the fair value when control is lost. So there will be a fair value adjustment that you need to make on these step disposals. Okay. And it's important to note that, again, they're trying to align with the IFRS 10 standard. So again, ensuring that there's convergence or alignment between full IFRS and SMEs. And there might be some implications here of determining fair value and, how you would go about it, but hopefully it will not be too onerous to do that. Okay. So the other element here also is that if a change in the parent's ownership interest without losing control. So currently in the SME standard, there's nothing really saying, particularly what needs to happen. Whereas now, with the new proposal, they would say that it will be treated as equity movements or equity transactions in a situation like that. Okay. So, what will basically happen is that if you have, let's say, a 60% subsidiary and you buy another 20%, what will happen is the movement in equity will be taken from the NCI and will be allocated to the owners of the business or the equity. Okay. So it's just the equity transactions. A transaction without any complications on it. Okay. And if there are any questions, please, post it. I'm going to go through this quite quickly because you would see there's a lot of slides that we need to cover. But it's important that, if you have a question that you're unsure of, please post it in the Q&A and then we'll address it. Okay. Right, moving on. So moving on again, relating to consolidations, we're only going to look now at the business combination side of things and how to treat goodwill. Also, a couple of changes that's being proposed here. So firstly, again, trying to align the definition of a business with what's in IFRS 3. So it's not really a big change, basically the same thing. So I'm not going to speak too much about it, but what is important is that you still have the inputs into the business, you've got your outputs, but very important, there needs to be an integrated set of activities to have a business. All right. Then also quite important is that, when you have acquisition costs, so let's say you have a business combination and you incur certain legal costs to facilitate the combination or the contract, ensure that all the contractual requirements are met. In the old standard, you were allowed to capitalize the cost of that to the cost of the business combination. So basically part of your consideration paid. Whereas now, again, aligning with IFRS 3, they would go and say, no, you can't capitalize it. We would require you to expense it going forward. Okay. So that is quite important. Right, I see there is a question. Okay, I'll chat to Mervyn. I'll answer your questions just now. Right, then moving on to the next one, also on section 19. So if you have step acquisition, so we've spoken about consolidation where you lose control, but now also when you gain control, what should happen? And again, they've brought in new guidance to facilitate this issue, because it still happens even though you have an IFRS SME reporter. Currently, there isn't any guidance on it. Okay, but if you look at the new proposition that they have, again, they are aligning with IFRS 3. So they say there basically what they think what they propose that should happen is that if you go and have a step acquisition where you go from, let's say, 40% to 80% ownership, and you obtain control, what needs to happen is that you take the previously held equity interest, so the 40% that you had previously, and you need to go and remeasure it to the fair value at acquisition date. Okay. And then based on the policy that you have, you can recognize that fair value adjustment either in P&L or OCI as per the accounting policy. So there's a bit of ambiguity there, because the IFRS standard basically tells you that you can choose based on your policy in terms of IFRS 9, how you want to account for it. Whereas this one, at this stage, they're not quite clear whether or not it will refer to section 11 or 12, or give you a pertinent direction in saying that you need to take it to P&L or you need to take it to OCI. Okay, so that's it for business combination. So I'm just going to do a quick basic example. So we've got Kingpin Pty Limited that acquired a 40% investment in the ordinary shares of in 2015 in Tops Pty Limited for 2 million rands. In 2022, Kingpin acquired a further 40% investment for 2.5 million, and therefore obtained control. Okay, so that's exactly what we've spoken about in the previous slide. So you had an initial investment of 40%, and now buy another 40% and obtain control. And now what is happening is, now you actually need to consolidate it. And now it's a business combination and you need to calculate goodwill. And what they're basically saying here also that the retained earnings at acquisition was 5,034,000 Rand and the share capital was 100,000 Rand. The non-controlling interest is measured at fair value at the acquisition date of 1 million Rand. And then also the fair value of the previously owned interest at acquisition date was 2.2 million. Okay. And then they also have legal costs at the acquisition, which was 12,000 Rand. And the question here that we need to answer is to calculate the goodwill. Okay. So let's have a look. So the first principle is the one of, what happens with the previously owned equity interest. Okay. So we had the 40%, which was bought at 2 million. All right. And then they say the fair value at the acquisition date for the previously owned interest was 2.2. So basically what happens now is that you need to go and increase that investment. Okay. So you say debit the previously owned investment, and that will be in the books of the parent. And then you would increase you would recognize a fair value adjustment. And in this case, I said OCI, based on the current guidance, is not clear. Could be P&L, it could be OCI, it could be a policy choice. But you need to account for that fair value adjustment as well. Okay, so it's 200,000 Rand that you need to go and recognize. Okay. Just a second, I just have someone I just need to talk to. Just give me 10 seconds, sorry. All right, apologies. I just had someone that came into my office. Sorry about that. So the previously owned investment was 200,000 that you need to increase, and you create the fair value adjustment. Okay. So what happens now is that previously owned investment also forms part of your consideration that you will transfer. So you would credit the previously owned investment of 2.2. Okay. So that's part of the investment, but you also have an investment of the other 40% in the previous example. So I'm just going to quickly hit back there. So that 2 million that you have there, also a previous, the new investment of 40% that you add. All right. So you add those two as part of your consideration transferred. The non-controlling interest, they say, was 1 million. Okay. The share capital was 100,000 Rand. The retained earnings, 5,034,000 Rand, which is recognizing goodwill at 166,000 Rand. Okay, so that's to calculate the goodwill, but also to journalize the subsequent or the legal costs as well. So previously, or in the current standard as it is, you are allowed to add that to your cost of the acquisition. Okay, so basically take it part as the investment in TOPS. But now with the new proposals, you need to go and debit it as an expense and not anymore as an investment or part of the cost of the investment. Okay, great. So yeah, that's it for business combination. So I think that I see there are 3 questions in the Q&A. So I'm just going to quickly deal with them before I move on. Okay, so I'm just going to miss that one. So the first question is, do consolidations have to be done if the directors feel that it is not necessary? So there is an exception, sorry for that. There is an exception, Mervyn, that you can apply if it is a fully owned entity. I just need to go and double check quickly on my side. Yeah, don't stress. I'll check a bit later. But there's a specific reference where it says if you're a fully owned subsidiary and your parent is also a fully owned subsidiary, then there is an exception where you don't need to apply it. Okay, I just need to go and double check it. I can't remember exactly. I know there is an exception, but it needs to be a fully owned subsidiary. That's I think the main or one of the big issues. Okay. So yeah, it's not about what the directors feel. I think that you need to be factual based on the facts and circumstances. And again, because there might be some minority or non-controlling interest that also needs financial statements and information. And in that case, then you won't necessarily need to apply it. But I think, yeah, I just need to double check it for you. That was actually a good question. I just need to refresh my memory on that particular one. Okay. Then Anthony's asking, what is OCI? Okay, so OCI, basically the full terminology of that is other comprehensive income. And the conceptual explanation for it is that, you know, it's something different to profit and loss. Okay, so it's still an equity type of movement, all right, but it's part of performance in a certain sense, but it's also not completely performance based, such as elements of profit and loss, such as revenue, cost of sales. So anything that, you know, requires fair value measurement and is not necessarily referred to as core to the business and profitability, the standards or the ISB says that they would rather want to see that going to OCI, which is your other comprehensive income. Okay, and that's why they have it there. Okay, so there's not a specific definition or conceptual explanation for it, and the ISB is also very authoritative in the sense that, you know, they say what goes to OCI and what they say doesn't go to OCI. Okay, so yeah, you know, it's a very good question because it can't really be defined what it actually is, because there's different ways of looking at it. And then the equity transaction. Okay, so important with that is, okay, so equity transaction basically means is that you buy shares. So let's say you're a parent company, you have an 80% shareholding in a subsidiary, and you decide to dispose of 20% of your shareholding. Okay, so what happens then is basically you just dispose of that that 20% of your current controlling stake, but you still control the company, and therefore it's just a movement between what goes from the owners, the parent company, and what goes to the non-controlling interest. Okay, so that's basically what it means. It's just a movement in equity and who holds the equity based on the equity at that specific point in time. So the equity that gets allocated to the owners versus what goes to the non-controlling interest. You just need to go and reallocate that based on the new shareholding percentage that you have based on that transaction. Okay, I see there's a couple of questions in the chat as well. So Gosia, I'll quickly just check there. I could have made a typo there. I just need to double check there quickly. Just going back there. Yeah, so the investment is 2.5. Yeah, sorry. So that, yeah, there's definitely a typo there. So it's 2.5. And then obviously, yeah, the goodwill will also change then. So it needs to move up by, if I do a quick calculation here, it will be 2.7, 3.7. Oh, no, yeah, 4.7, 5.7. Yeah, it will be 566 then instead of 166. All right, so there's a couple of typos there. Apologies for that, but the principle remains the same. Okay, so you need to recognize goodwill based on that. And yeah, the important principle that you need to take into account here is the previously owned investment, okay, of 2.2 that you bring in at fair value, okay, and it forms part of your investment. And then one other thing is obviously legal cost that gets excluded from your cost of the investment, so it gets treated as an expense. All right, cool. Yeah, Yapi, there was a typo there, so 100%. So I'm just quickly answering you as well. All right, apologies for that typo. So I'm glad that people are awake and checking the calculations. Perfect. Moving on to investment in joint ventures. So if we go to what the proposed changes are on section 15, it's basically, yeah, it's not a lot of major changes. So again, the definition of joint control has been aligned to IFRS 11. And if you go and read the two definitions there between, as it currently stands in the proposed version of it, is that, you know, you still need unanimous consent. You still talk about what is joint control, which is contractually agreed sharing of control. But the big thing is that the change is that in the new proposed version, it could be that they refer to relevant activities instead of looking at strategic and financial operating decisions. So it's just a word change. I don't think it will change fundamentally how you apply the definition, but it's just to align it with IFRS 11. Okay, and then the one there at the bottom is something I don't see often. So basically, when you have accounting for joint operation when no joint control exists. So basically, when you have an asset that there is no specific joint control on that particular asset. Currently, there's no guidance, but what they say, what they propose, and that's what's considered in IFRS 11 as well, is that you still account for it based on the proportion share of the joint operation on a jointly controlled asset. So, you know, there might be an agreement that say, you know, you have 40% interest in this asset and the other person has 60, and then what you do is when you consolidate, you still consolidate the 40 in your books or the 60 in your books, and vice versa with the other side. Okay. So the accounting there will still be the same, even though there might not necessarily be joint control on that particular asset. All right. Okay, so then if we look at financial instruments, okay, so this is one that, you know, is quite interesting, and you know, there is some very specific changes that needs to happen here. All right, so and I'm just going to quickly go through it. So The first one is the classification of the principles based on the characteristics of the contractual cash flow. So currently, the old standard uses certain buckets or certain definitions for how you would account for amortized cost type of asset, or when it's at fair value, etc. Whereas the new or the IFRS 9 standard on full IFRS provides specific guidance conceptually on what to look out for. And there they say you look at the characteristics of the contractual cash flow. So for instance, if you've got a loan that you grant to someone else, you would look at how you would manage those cash flows. So you look at the characteristics, but also the business model. Okay, so the first thing is that if you look at the characteristics, if it is solely for the purpose of principal and interest, and you just want to there's no other elements to it other than time value of money or credit risk exposure, then you would see it as a normal amortized cost type of investment, just like a normal loan. Okay, and the second part is if you have a business model of only collecting those cash flows, it will also mean that you will need to recognize that amortized cost. But then the interesting thing is, and if there is elements of trading with this instrument, so for instance, if you have a business model where you have these loans and you collect contractual cash flows, but you also sell these loans to other parties, based on your business model, then it could be a situation where that you have a dual approach. And then in that case, it could mean that the classification would then change from amortized cost to rather go to fair value measurement through other comprehensive income, OCI. So that is the proposed changes that they are bringing in. So obviously, there's not a lot of stuff that we can talk about in terms of that, because we're not sure what specific examples are going to put in. So I just worked from the ISB decision document. But what they're trying to say is that if you look at the current standard as it is, section 15, they will keep the old examples there, but they will also add new examples to supplement the existing examples to show you how it would be based on the characteristics of the contractual cash flows and not as it currently stands, using that bucket approach of section 15. Okay. Then what is also important is that currently there's an option to apply recognition and measurement requirements for financial instruments in terms of the IFRS standards, so IFRS 9 and IFRS 7, etc. But with the new proposition is that they want to go and remove that option, so that you only focus on the guidance that's in the actual standard. And what is important here is that you need to go and look at the guidance that they will change, and that's obviously why they say they're going to provide more classification principles and measurement principles from IFRS, and to bring in that characteristics of the contractual cash flows, etc. Right. Good. Then another big change, and this I think might be the biggest one on financial instruments, would be the one on expected credit losses. So currently, as it stands in the IFRS SME standard, is that you basically working on a objective evidence or incurred losses model for impairments or bad debts in layman's terms. So currently, as it stands, if I just read what the standard says, they say at the end of each reporting period, an entity shall assess whether there's objective evidence of the impairment of any financial assets that are measured at cost or amortized cost. If there is objective evidence of impairment, the entity shall recognize impairment loss in profit and loss immediately. Okay. So basically what that means is that you wait until you've got that evidence and then you impair. Okay. So it's pretty much a catch-up method or a backward-looking method where you wait and see, and if it happens, then you impair. Okay, which is not necessarily as useful. All right, and with a new proposal, I'm just going to bring in some slides from IFRS 9 where we can just talk about what the impact could be now if they go with this expected credit losses model of IFRS 9. So basically what happens, if I can just put it in layman's terms, is that like I just said now, the current model is that it's they wait for objective impairment and then objective evidence and then they impair. Whereas with the IFRS 9 model is that you go from the moment you recognize that particular financial asset, from the moment you recognize that you are exposed to a form of credit risk. Okay, and that credit risk needs to be reflected from day one when you recognize that asset up until the end where you dispose of it or you do recognize it. Okay, so you need to show the credit loss that you expect to see on that asset over the course of the life of that asset. Okay, so it's pretty much a forward-looking model instead of a backward-looking model. Okay, and yes, it will require you a lot more work in terms of getting information about your debtors, the credit quality, look at trends, try and see where things are going. If you look at the state of the economy, the oil price, what impact that will have on the what do you call it, on the consumer's ability to repay debt, etc. So all of that you need to take into account then for this model, pretty much a forward-looking approach. So, and again, there are two models on the IFRS 9 model. They've got the general ECL model, but they also have a simplified model. And again, currently as it stands, there's not a lot of information to say which one will be appropriate, whether or not they will go with a general model or whether or not they will go simplified. But what isn't clear is that they want to go with the expected credit loss model. All right, so what will happen is that when you initially recognize an financial asset, you will have probably low credit risk. Okay, so in that case, you will create an allowance based on future projections for the 12-month expected credit losses. Okay, so what that basically means is that you look at the life of your asset, all right, and you go and provide an allowance or provision for the amount of credit losses that you will have, that you expect to see within 12 months on a particular asset. Okay, so that's when you have a low credit risk. Okay, so what happens then is that in life, you miss a payment. If you think about a bank, someone's got a loan with the bank, and if you start missing a payment, immediately you start increasing your or the risk that there could be a default on that particular asset. So what happens is that if you have a situation where that credit risk increases significantly since initial recognition, you've got higher credit risk, and therefore you move to a higher allowance on your expected credit losses. So where you would have recognized 12-month expected credit losses, then you look at your whole life of the instrument and you recognize a lifetime expected credit losses. Okay, so for the whole instrument for the whole life and not only for 12 months. So obviously it's a higher amount, and it's important to go and assess the higher amount of credit risk that you might have on a particular item. Okay, and again, if I just can talk about that a bit loosely, is that what will happen is that if you have a situation where someone defaults, and again, the guidance will need to be clear on this, but in IFRS 9, they've got a rebuttal presumption that after 30 days, if you default or if you miss a payment and you're behind with your payments for 30 days, it triggers a significant increase in credit risk. But you can obviously go and rebut it, but that's basically the presumption that sits in IFRS 9. Right, and that's the second stage basically, and then you've got the final stage. All right, so and this is basically more or less aligned to what is happening the current section in IFRS for SMEs is that if you have objective evidence that this instrument is impaired and credit impaired, then you would go and recognize an impairment loss. You would reduce the amount against your instrument, okay? And basically what you would do then is if you charge interest, you will charge interest at the net amount of after you've deducted the impairment losses, okay? Because effectively you won't be recovering the ones that you had on the gross amount, and if you would raise interest on that, you would double account for something that you won't be able to recover. Okay, so that's why if you charge interest on a credit impaired instrument, you charge it on the net amount and not the full amount. Okay, so that general ECL model, and again, sorry if I if you must just stop me if I need to explain it again. This is quite a new concept, and we can have a couple of questions on it. But just to explain this ECL model again, is to say, like, okay, you've got 3 stages, and this is basically the first stage is when you've got low credit risk, okay, and basically what is shown there is that you've got a portfolio of instruments, your debtors, or a portfolio of loans, and they all have low credit risk. Okay, and that low credit risk can stay there up until the end when you actually dispose or de-recognize that particular instrument or portfolio. But what will also happen is that if you have this if you have some of these loans or some of these assets that might have defaulted or missed a payment, and there's a significant increase in credit risk, you take those out of that grouping, and you take them and you measure them at the 12-month expected credit losses, because there's a higher risk of credit, and therefore you need to go and recognize it as such. Then also what needs to happen is that if you go even further in stage 3, the ones that you have there from stage 2, some of them might have objective evidence that they are impaired, and then you take them out of that grouping there, and you say, okay, I've got specific credit impaired assets in this grouping, and I'm going to go and fully impair or impair that to a certain extent and recognize interest on the net amount subsequently. All right, so hopefully this illustrates more or less the process that will be followed. So again, I'm not sure what model the ISB would propose, but this is the general one that they have on IFRS. Okay. Then I've talked about this. So I've just added this slide. So apologies for not. I saw I didn't have that in my final pack. But basically what this slide just speaks to is what I've mentioned there. So you need to assess the risk of default occurring over expected life. And if you've got reasonable and supportable forward-looking information, you go and assess whether that increase in credit risk is there. Okay, and this comes from the IFRS standards. So obviously that it could be different for IFRS for SMEs, but again, you need to go and assess that on each reporting date if there's a change in risk. So again, just on that, and again, I didn't add this slide, but I can just send these slides to you afterwards, and you can have a look at it. So basically, what the IFRS standard is referring to is again about the measurement of the ECLs. So, like I mentioned at the start, it's losses that might result in possible default events. Okay, so it's forward-looking. It's defined as consistent with the internal risk management practices. So you need to define as a company what, in terms of a credit risk, what is considered to be a default, and based on that, you would recognize your ECLs. And then, in terms of the measurement, there are 3 very important elements that you need to take into account. Okay, so if you measure this ECL, it needs to be unbiased information that you use. It needs to be probability weighted, okay? And you need to cover a range of outcomes. So you need to make a proper assessment of what you expect those losses to be. So if it's a long-term type of asset, like a loan, You need to take into account the time value of money. And very important then, the information that you use to do the estimate, it needs to be reasonable information, it needs to be supportable information, it needs to be information based on past practices, current situations, but also taking into account future impacts of the economy, for instance, or a specific customer base. So you need to take that into account as well. Okay. All right. And I think I've covered the ones here at the bottom as well. So maybe I can just explain again the concept of the time value of money. So what you need to do is, if you have an element or an asset that has elements of time value of money in it, you need to compare the contractual cash flows that it is currently versus the contractual cash flows, the present value of that, what you expect to receive, and that will be obviously your loss amount. Okay, so that's just a simple way of putting it. But then I've spoken now about the general approach. So there's also a simplified approach that you can apply. And the simplified approach is actually, yeah, it's fit for purpose for what it's meant to be, which is the simplified approach. So it's mostly used for financial assets where there isn't significant financing. So for instance, if there's no time value of money elements in there, such as trade receivables or short-term financial assets. And in that case, you can apply an easier method. And in this case, it would be skipping the 12-month expected credit losses and rather going for the lifetime expected credit losses. Okay. And again, it could be based on your accounting policy. And the method that they will apply for this would be using a provision matrix. So it sounds very fancy, but basically what happens is that if you have debtors, you've got your debtors age analysis, and you basically go and say, based on this age analysis, what is my loss ratio for each bucket for 30 days, 60 days, 90 days, 120 days? And you work out what your expected losses would be on a historical trends based on that loss ratio. But then also what you need to do is you need to go and say, because this is only backward looking, I need to take into account forward looking information as well. And then you just update the forward looking information based on the historical trends in your calculations. Okay. And very important is that you can go and diversify. So obviously when you look at your age analysis, you've got different types of customers in there. You've got customers with very good credit quality. You've got customers that are possibly credit impaired. You've got customers that might be in business rescue. So based on that, you need to go and disaggregate those elements of the age analysis to come to a proper answer on this provision matrix. All right. Yeah, so I've explained that in the previous slide as well, so I'm just going to go through it in detail again, just quickly, just recapping. So you're looking at your age analysis, and you can segment based on geographical region or sector. What is also important is that if you look at the default rates, all right, it's based on historical information, like I mentioned. You can have trends based on 2 or 3 years of experience, but you also need to take into account for forward-looking information. So, for instance, COVID-19. So, what do you expect COVID-19 to have an impact on your customer base and the ability to repay? Possibly the oil price, the increase in the oil price might reduce the consumer spending and ability to pay their outstanding debt, and that could also have an impact on it. The war in Ukraine, etc. So there are elements that you can bring in, but you need to be able to justify how that impacts your loss rates. Okay. Okay, so yeah, that's basically taking into account the forward-looking information as well. So for me, if I just can quickly just ask a poll question. So Danny, if you guys are already there. So the question would be, which do you think provides the most useful information regarding credit risk and credit quality? Okay, so only choose one of them. So do you think forward-looking information would provide better information, or do you think the current incurred losses approach would provide better information? So I'll open it quickly and just to see what the audience says on this. All right. You can go. So I can't, yeah. So Danny, you need to guide me. I can't see. So
Yeah, I've opened the question, the poll up. I was just thinking, I'll give you guys and looking at the time, if we now just give them the 5-minute stand up break to
yes.
to answer, and then we'll close the poll and we can restart.
Perfect.
Closer
Yeah.
to
Okay. So we
3.
can keep it open for 5 minutes. I think it's a good point, Danny. I think I only have revenue left, so yeah, I would have stopped here just after the poll. So we can keep the poll open for 5 minutes, and then we can start, let's say, at 3 o'clock and just do the revenue part of it. Cool.
Just as Milan mentioned, these last few pages weren't in his original notes. He will add them in and send them to me, and then I'll send them out to you guys a bit later. Okay, last minute, just to get some questions in. I'm seeing a few more, 1 or 2 more still answered. But yeah, I'm going to be closing the poll in a couple of more seconds. I think pretty much everyone's answered. And I'm going to share it, and we're going to start the second session. Okay, Milan, you should be able to see the results.
Thank you, Danny. Yeah, I can see it. I think everybody in the audience can also see it. So yeah, so about 38 of you have voted in, and it seems like 79% of you are saying that a forward-looking approach will provide you better information, which that's the reason why the ISB also went this route when they did the changes for the IFRS 9 standard, or the proposals for the IFRS 9 standard. And it's all about, you know, a big part of it's because of the you know, defaults during the global financial crisis. You know, everybody was looking at the incurred losses model, but they didn't see the problem coming. And that's why they moved over to this forward-looking approach on the ECLs. And yes, unfortunately, it puts a bit of a burden on the preparer to go and estimate and think about, what your losses would be, your loss rates, what your defaults would be, and what the impact would be from future events that, the forward-looking information that you need to look at. But it provides the user such a more rich information to understand, how the company manages their credit risk and how they are exposed to credit risk in their company. Okay, cool. And yeah, so that's it. Thank you for everybody for voting. There will be another poll a bit later. So I'm just going to move a couple of things around here. I see some stuff floating. Yeah, how's that? All right, so we're going to move on to revenue. So, so the revenue is actually such an important section, and that's why I will spend a bit more time. The next half an hour or so will definitely be on the revenue standard or the revenue section itself. And yeah, like I mentioned, it's so core to businesses, because a lot of businesses they do their performance bonuses, or they measure performance based on how revenue performs, and revenue drives a lot of the profitability. If you look at EBITDA or profit after tax or before tax or operational profit, if the revenue figure is not solid or it can't be understood, then it's difficult to have proper analysis of performance in the organization. Okay, and basically what it comes down to is that what the ISB wants to propose is that the current IFRS for SME section, revenue section 23, will need to be aligned with the IFRS 15 standard. Okay, so basically what I'm going to do is I'm going to explain to you what the IFRS 15 standard is all about. Okay, and if you have any questions, you can ask me. I'm here to assist, because a lot of these concepts are very, very new, and something that would require some thinking and realignment. Okay, so let's talk about the core principle first of IFRS 15. So they've got very fancy words of explaining what the principle is. So I'm just going to read it out there. So they say the entity recognizes revenue to depict the transfer of goods and services to the customer in an amount that reflects the consideration to which the entity is expected to be entitled to in exchange for those goods and services. So basically what they're saying is that you need to recognize revenue to show how you are transferring the goods and services, and it needs to reflect the amount that you expect to be entitled to. So what amount you expect to receive at the end of the day, okay, for those goods and services. All right, so I basically said exactly what has been said by the ISB, but it's important just to rehash it. Okay, and what the ISB has done is they said, okay, for IFRS 15, we've got this whole 5-step approach in how to recognize revenue. Okay, so you would see some of them relates to recognition, others relate to measurement, but I'm going to quickly just talk to each one of them. So step 1 is to identify the contract with the customer. So it's and the reason why they have this here is to ensure that you've got enforceable rights and obligations within a contract. So because if you don't have enforceable rights and obligations, you cannot recognize revenue, because then anybody can jump out of the contract and it falls flat. So there needs to be enforceable rights and obligations within the contract, and that establishes the rights and obligations for what you need to deliver, what you will receive back, any time frame, any payment terms, etc. So the contract is core to recognition for revenue in IFRS 15. Then the second step is that after you've established the contract, you look at the performance obligation. So you go and say, okay, what do I promise as an entity? Do I promise to sell cars, but do I also promise to sell cars plus a service plan or plus a maintenance plan? So what are those promises that you make, and how does that do I need to recognize them separately, or can I combine them? How do I approach that? Then step 3 is you need to go and determine what the transaction price is. So what do you expect to be entitled to as part of your contract? Okay, so what will you measure for revenue? Then step 4 is basically a mathematical exercise. So what they do is you go and take the transaction price and you allocate that proportionately to the performance obligations, okay, that you've identified in step 2. I'll speak to that in a bit more detail a bit later. And then lastly is the very important one, and that's where some of the biggest changes are, is with the how revenue should be recognized. Okay, so I've just summarized it quickly there. So it's basically the when and how revenue should be recognized, either at a point in time or over a period of time. So the IFRS standard has a fancy way of saying it. They say, you recognize revenue as or when you satisfy the performance obligation. Okay, which is, it's basically the same thing that I said there, just in different terminology. Right. But now, let's have a look at a very important principle. So the principle of control. So that for me differentiates the current Section 23 and the old IAS 18 standard with the IFRS 15 standard. So if you look at revenue in the current standard, you look at transfer of goods and services, then you look at risk and rewards being transferred, you don't have current involvement with the assets that you've transferred over, etc. Or if it's a service that is based on the percentage of completion, and there's certain criteria that needs to be met. Okay, for interest, it's on accrual basis or effective interest rate method or whatever. But with IFRS 15, you look at control. So you look at, you've got an asset that you are transferring over to another party, and that control can be either over time or at a point in time, and that's why step 5 is so important. Right, but let's have a look at step 1. So let's start from the start or the beginning. So there are certain criteria that needs to be met in order to establish the enforceable rights and obligations. So there are basically 5 things. So firstly, the parties need to approve the contract and are committed to perform their different obligations in the contract. Secondly, there needs to be rights and obligations that can be identified. There needs to be payment terms that can be identified. There needs to be commercial substance. Okay. So what's important here is that you need to have, a risk that you're exposed to, maybe possibly credit risk. There must be an impact on the cash flows. So there must be commercial substance behind your transaction. You can't just have a transaction and you don't expect any money to come in and you just make fictitious transactions at the end of the day. Okay, there must be commercial substance. And then lastly, the collection of the consideration must be probable. Okay. And there you look at the customer's ability and intention to pay. So if you enter into a contract with a customer, let's say Sunroll. Sunroll is a wonderful example here. So everybody knows we've got gantries here in Johannesburg where, you pay the e-tolls and, every time they take a photo of your number plate or your license disc, and I don't know if you get an invoice, but, you should get an invoice that you get and say that you owe this amount of money to Sunroll. Okay. But, can they go and recognize revenue on it? That's the question, because, some people don't have the ability to pay that e-toll fee. Okay. So that's point number 1. So people can't pay it, so they won't ever receive consideration for it. So they can't recognize revenue based on that. Secondly, intention to pay. So many people are just saying we're not paying. So Sunroll is a good example of that last little bullet point there, where, if the customer don't have the ability or intention to pay, then you cannot recognize revenue because it's not a valid contract. Okay, right. And it's almost like a hurdle before you can actually meet the criteria for IFRS 15. Okay, good. Then very important also is that a contract cannot exist if each party has a unilateral or enforceable right to terminate an unperformed contract without compensation. So if any of the two people in the party, in the contract, can just go out without penalties being imposed on that person or any repercussions, then you don't have an enforceable contract. Okay, and that's why it's so important to to have enforceable rights and obligations that speaks to that. It needs to be a approved contract, and people, the parties, need to be committed to perform. Okay, so that's the first step, basically. And then, very important here also, it's something that's very, very common with COVID and everything that happened now with the war on Ukraine and people that needs to make modifications to their contract. So, yeah, it will happen in practice, and currently there isn't any guidance in the SME standard or really in the old IAS 18 standard. If you look back at the old IFRS, there wasn't a lot of guidance on it, and here they actually bring a lot more guidance for people that want to do contract modifications. Okay, so there are certain simplifications that the IASB proposed for the SME standard, so they don't need to do the full contract modification approach for full IFRS. They have simplified models. But basically what will happen, if you have a contract modification, so that's usually when you have a scope change in the price, it's a change in the scope or the price or both of them, and if it is approved by the parties in the contract. Okay, and then again, if you talk about approved, it doesn't need to be written. It can be orally approved. It can be implied by business practices. So again, as long as it's enforceable rights and obligations, you can have a contract modification. Okay, so basically for accounting for contract modification, you can account for prospectively. Okay, and there, there's the IASB hasn't been clear on that. They just say, you can do it prospectively. In IFRS, it can be terminating the old one and creating a new one, or just have a separate contract on the new one based on new information. The IASB not clear on the current stance of that, but they will have a prospective change for a modification. But also there would be retrospective changes, like a cumulative catch-up basis. So that's usually a very simple one, and we'll look at an example on it. We'll have a look at an example on both of them, actually, just to see how that will work. Okay, so just to summarize the contract modifications. So with a retrospective, it will be a situation where you don't have distinct goods and services, and you need to assess the contract as a whole. Okay, so then it will usually be for something like a construction contract or service where you need to catch up lost revenue or catch up on revenue that you recognize prematurely on the contract based on new information. Okay, so but we'll look at an example of that. And then prospectively basically means that from the new information, the modification, you need to change the contract going forward. And what happened in the past, you don't change that. Okay, so the simplification, that's based on what the IFRS wants on IFRS 15, but the IASB proposed a simplification. So you will have a prospective basis in SME standard, but it will be a single approach. Okay, so you won't have a choice between separate or termination of a contract. You will have one single approach for prospective modifications. And again, currently as it stands, I don't have a lot of information, but it is something that the direction where it will probably go for revenue recognition. Okay. All right, so let's have a quick look at an example of contract modifications. I need to quickly go through this. So on 1 January 2020, ACE Limited entered into a contract to sell 1,000 hand sanitizing units over 12 months. The contract price is 100,000 Rand. By the end of March, South Africa went into a nationwide lockdown to flatten the curve. On 31 March 2020, 700 units were delivered, and the customer decided to order an additional 500 units on top of the 1,000 at 80 Rand a unit. So there you can see there's a modification in the price and the scope. Okay, the reduced price is mainly due to a refund because of the volume of the order, and therefore is deemed to be extension of the existing contract. Okay, so basically what needs to happen is that it's an additional order. Okay, the output is distinct but not on a standalone price of the 100 Rand. So it means that basically we need to adjust the value of the undelivered units prospectively. Okay, so you need to basically combine them and account for them prospectively. Okay, so what have you recognized? You recognized 700 of them at 100 Rand, which is 70,000. That's up until 31 March. But then after March, you still have 300 at 100 Rand, but also 500 at 80 Rand. So you add them together, okay, which is 70,000, and then divided by the total units that you still need to sell. And then prospectively, right, you will go and sell the units then at 87, or you recognize revenue at 87.5 Rand per unit. Okay, and that will be the prospective adjustment. So based on what you would sell for the remainder of the year, you will recognize it at that price per unit. Okay, so that's an example of prospective changes. Then if you look at retrospective change, so again, here you've got a construction company. So Buildco Limited entered into a contract to build an office park for 20 million. The 20 million included 15 million for the rest, for the first phase, and 5 million for the second phase. Okay, so 2 phases. The estimated cost of the project was 14 million, and the year end is 30 June 2020. Okay, 8.4 million of the costs were actually incurred by 30 June 2014. It was actually 2020, so that's a typo. And on 30 June 2020, the customer decided to only keep phase 1 of the project as part of the cash management strategies in the COVID-19 outbreak. The decision meant that the contract price was reduced to 15 million on 30 June 2020, and the estimated cost of the project was decreased by 2 million rands. Okay, the modification is deemed not to be distinct but an extension to the existing contract. Okay, so you would go retrospectively on this one. Okay, because it's a single performance obligation. We'll talk about that a bit later. But basically what you need to do is you need to recognize the revenue that you had up until 30 June. Okay, so you take the 8.4 divided by the 14 million budgeted cost. Okay, and you get a ratio based on percentage of completion times the full price. Okay, which will give you the 12 million up until that point. Okay, but now after the modification, you need to go and adjust it, because you need to go retrospectively and adjust it. So then you go again, the actual cost stays the same. The budgeted cost has reduced to 12 million. Okay, so your percentage of completion is further, but also your contract price, the transaction price, has changed from 20 million to 15 million, which means that if you calculate that, you get to revenue that should have been recognized of 10.5 million rand. Okay, and then basically what it means is that you recognize revenue, too much revenue, and you need to go and retrospectively adjust for 1.5 million in the financial statements. Okay, good. So just to explain the difference between the two sections, or the two approaches, and that's it for step 1. So let's have a look at step 2. So to identify the performance obligations in the contract. So it's basically to identify what you are promising, okay, and what you can actually identify for revenue recognition. Okay, so at contract inception, you would need to go and assess the goods and services promised and identify performance obligations as either as goods and services that is distinct, or a series of goods and services that are substantially the same with the same pattern of transfer. So this could be something like a maintenance contract, or a cleaning contract. If you've got a business where you do cleaning contracts for 12 months, it means basically that each month is not a separate distinct performance obligation, but that you are looking at the 12-month contract as one distinct performance obligation, and then recognize revenue over the 12 months. Okay, because each month have the same pattern of transfer. All right, but the goods and service that needs to be distinct, and there's a separate criteria that you need to go and assess for that. Okay. So there is a simplification for SMEs. So they are permitted to account for the promise as a series of distinct goods and services that are substantially the same and that have the same pattern of transfer to the customer as a separate performance obligation if the amount of the consideration varies in a way that corresponds with the value of the distinct goods and services. Okay, right. So just to simplify the accounting there. All right, so let's have a look at when something will be distinct. So firstly, you need to have the ability to use the customer needs to have the ability to use that good on its own or together with other resources. And important there is that if you can sell something regularly, it usually tells you that that the customer can benefit from it. Okay, because there is some value in that particular item. But you also need to be able to separately identify this particular promise from the rest of the promises in the contract. So this promises need to be able to be separated from the other promises. Okay. So basically what you need to be able to see is like if you have 3 promises, which ones can you separate from each other? Okay. So there are certain criteria that applies, or certain indicators that apply when something will not be separately identifiable. Okay, and this is actually to help people, because this is one of the more complex areas that people struggled with the application of IFRS 15. So the first one is indicators. If you have a service of integrating goods and services with other goods and services into a bundle of goods, or service that represent a combined output of the customer for the customer, that would be seen as one single performance obligation. So a good example of this would be if you have a construction company, you build a office building. You know, you might provide the bricks, you might provide services of constructing, you might provide engineering services or architectural services. So all of those promises are promises in the contract, but they are combined and integrated into the output, which is the office building that they are building. And therefore that would be one single performance obligation. Then the second one would be for a good or service to be modified or customized the other one. So if some goods modify the other goods, then it's a one performance obligation. So if you sell white paint and black paint, okay, but you actually combine them to deliver, or you promised those 2 paints, but you actually what you want to provide at the end is gray paint, that would also be seen as a single performance obligation, because they modify or customize each other. All right. Then the last one is that if a good is highly dependent or highly interrelated with other goods and services. So for instance, again, like a construction contract, you can't use the bricks without the actual people that are building it or providing the service of constructing. Okay. So that's a good example. You can't have the one without the other. They need to be there together to be able to deliver the goods. All right. So let's have a quick poll question again, Danny. So the question is, if you are a solar panel system installer and promise the following as part of your service to the customers, how many performance obligations would exist? So if you've got solar panels that you are promising, batteries, the inverter, the installation, how many would you actually recognize based on the criteria that we've spoken about just now? So I'm going to open it up for a minute. I see we're a bit behind in time, so I'll try and speed it up a little bit. Okay, so are there 1 performance obligation? Are there 2? Are there 4? Okay. So Danny, I'm not sure how many people have voted.
About half the people have voted so far. I'm still getting a few answering every.
All right. You can count it down if you want to.
Yeah. Let's give it 5 more seconds. It's 5, 4, 3, 2, 1.
Okay. All right. So pretty much split there between the three options. So 38 of the people saying that it's a single performance obligation. 26% of the people saying that there are two, and 35% saying that there are four. Okay. So a very interesting question here and a poll, because it's actually quite debatable. So, obviously it depends on the facts and circumstances. And, that's why I think it's important just to get the opinion out there. But, for me, based on my experience here, is that I would say the solar panels and the inverter would most likely be, together, because you can't really separate them from each other. So they're highly dependent on each other, because you need the inverter to actually get the electricity at the end of the day, because the output that you want to get is the electricity from this, but they install it, and you can't get electricity if you don't have the inverter. That's my understanding of it, but I'm not the expert yet. The batteries, again, you could also argue that the batteries can also be added there, because what will you do with the batteries if you don't have the solar panels and the inverter? Okay. The installation is an interesting one. So the installation, sometimes it can be that one person can provide the components of the system, but you don't need to use the installation of that particular company. So in that case, if you can get someone else to do the installation on the solar panels, the batteries, and the inverter, then that could mean that could be separately identifiable, because it's not highly dependent on that particular installation. All right, and therefore, my view is that there could be two here. All right, definitely not four, but I think most likely two. But it's a debatable issue. And again, it's based on the facts and circumstances and how it could influence the use of these components. All right. I see there's one question. I'm just going to quickly just tackle that one. Okay, so Anthony asked about how do you understand control over the relation of the service contract. So that one I will answer when I go to that slide. There's a particular principle on that. Cool. So step 3, determine the transaction price. So I'm going to go quickly through this one. So it's basically, what you expect to receive in the contract. Okay, so you look at the terms of the contract, customary business practices, but it's the amount of the consideration that you expect to be entitled to in exchange for the goods and services. It excludes amounts on behalf of third parties. So if you're an agent, or for instance, if you collect the VAT on behalf of SARS and you pay it over to them, the VAT gets excluded from the contract price. And then it could include fixed amounts or also variable amounts. So I'm going to focus on the variable amount part. So again, there's a lot of estimation that needs to take place here. So first you need to identify what is the variable component in your contract. You need to go and estimate it using the expected value or the most likely amount. And then, very important, there is an element of constraining estimates that you need to take into account. So sometimes if you're not certain, it's not highly probable that you can see something happening in the future, you cannot go and recognize that variable consideration. So IFRS has got a lot of factors that you need to take into account. So the simplification for the SME standard would be that variable consideration will only be recognized to the extent that it's highly probable that the variable amount will be recovered. So if it's highly probable and you're satisfied that it will be recovered, then you can actually go and recognize the variable amount as well. So it's a very high hurdle to actually go and recognize variable consideration. Okay, cool. And then you obviously go and recognize it at the end. So I'm not going to go through the detail here. This is just the way you can go and estimate it. You can do either a probability weighted or a most likely amount. I'm not going to go into the detail there. All right. I also have an example here of sale of a right of return. So again, I thought, for the sake of time, I'm not going to go through the detail here. It's pretty self-explanatory. So what it comes down to is, what can you recognize and what should be considered to be a liability instead of revenue. Okay, and that highly probable element still remains here. Okay, so that, if there are any questions, Danny, you can ask them just to email me, or you can email me and I can just reply on that. Okay, good. So then there's also the concept of significant financing components. So basically what happens is that if you transfer goods, let's say today, if you only transfer goods today, then you would only, and you will only receive payment, let's say a year or 2 years from now, there's an element of financing that you need to go and take into account for recognition of revenue. So what will happen is that you need to adjust the consideration for time value of money to show or reflect the amount that you would have paid cash at the time of goods or services. Okay. At the time that the goods and services have been recognized. Okay, so the question now is, how would you account for the financing components? So currently, it should, well, as it is proposed, they say it should be accounted for in terms of section 11. So as a financial instrument, sorry, I'm just going back there. But there's also a practical expedient here. So it is not required if a payment term is less than 1 year. So if you, let's say, you transfer the goods on 1 January, but you get the money at the end of the year, 31 December, and that's your financial year end, you don't need to account for any time value of money. So then you can just account for it as it is. Okay. But very important here is that, when you identify a significant financing component, you need to be able to assess all the facts and circumstances. So, sometimes it's clear to see. Other times you need to go and look at, how long it's, or how big the difference is between the transfer of the goods and services versus the amount that you receive at the end. Okay. And also the interest rate that you charge, etc. So there are different elements to also look at. So here is a quick example of a financing component. So I'm just going to quickly run through it. So Accent Limited is a real estate development entity that entered into a contract with a customer for the construction of a residential complex on 1 January 2019. The residential complex is expected to take 2 years to complete and will be handed over to the customers at the end of the contract in 2020. Okay. It was determined that the contract does not meet the requirements of paragraph 35 to recognize overtime, and therefore will be recognized at the point in time. So we'll discuss that a bit later. So the payment terms are as follows. So they pay 500,000 Rand as a security deposit at the start of the project, 2.5 when the legal title has been transferred, and then another 1 million after 2 years after the contract has, after the complex has been transferred. Okay. So Accent Limited, Pty Limited, has a 31 December year-end and market-related interest rate applicable to the entity without considering credit risk is 8%. But if you consider the credit risk, it is 10%. So just a top tip here. So when you're looking at the discount rate, you need to consider the customer's credit risk, okay, for discounting purposes. And therefore, the 10% will be appropriate in this case. Okay. And the question is then, let's have a look at the journal entries for each of the years. So let's move over to the next slide. So firstly, in 2019, what happened? You received cash, but you haven't transferred it yet. So what will happen is you obviously debit your bank, but you still have an obligation to transfer the building or the complex. And therefore, it's not revenue, but rather a contract liability or income received in advance. Then what happens in 2020? You need to go and recognize the revenue based on the information that they've provided. Okay, so you actually go and recognize the complex building, all right, and you receive cash for that, so that you have the 2 million that you received in 2020 on the date of the transfer. You remove the contract liability, so you debit the liability that you had initially for the security deposit, but you also need to recognize the present value of that final consideration that you have, that 1 million that you pay 2 years from now. So what you'll do is you take the 2 million, the 1 million that you pay 2 years from now, and then what you basically do is you take the 1 million, which is the future value, 2 years from now, you discount back using 10%, and then you get to that 826,446. Okay. And that would be the amount of revenue that you recognize in 2020. Okay, so what will happen subsequently is that you would go and create a debtor, all right, and you have a finance income on that contract debtor. Okay, so the increase in 2021, there are no payments. So you take the amount that you had here at the top, the 826,446, and you multiply by 10%, and that will be your interest for the year. Okay, and then in the final year, the same thing happens. You have your contract debtor, increase the finance income again by the 10%. And then at the end of 2022, you would go then and say, all right, I received the cash of 1 million, and you do recognize your contract debtor with the 1 million as well. Okay, and that's more or less how you would account for it. So it's a lot of amortization in terms of, you know, the financial instruments section. All right, so you just need to account for it, you know, accruing the interest using the effective interest method. Okay, good. So in terms of step 4, you need to go and allocate the price to the identified performance obligations. So this one is very simple. So you take the number of performance obligations you had, and you take the price that you've determined, and you allocate the price to each of those performance obligations. And what you need to do is you need to basically illustrate the amount that you would consider to be entitled to. You need to go and link it to those performance obligations that you have. Okay. And the question now is, how would you go and allocate it? So what you would do is you go and allocate based on the standalone selling prices of each performance obligation. And that's quite simple to determine. It can be based on the price list, quoted price, or whatever that you have. And that you allocate that proportionately based on that standalone selling prices. Okay. But there's also a simplification. So if there's other ways of doing it, if there's an alternative method in the SME standard that provides more faithful information, then you can use that as an alternative method. All right, but obviously you need to go and explain that. All right. So this is the last one. I'm almost done. So I'm going to just quickly go through step 5, but this is the actual recognition. So this is where everything actually comes together. All of the first 4 steps needs to now translate into step 5. So there are 2 questions. I'm just going to quickly, okay, there's joint ventures. I'll quickly talk about that at the end. Then Alan is asking, how do you obtain the market-related interest rate for the entity? Yeah, that's a good question. So I would, so obviously I'm not in practice, so I don't know the ins and the outs here. So my sense would be is to go, first you start with the prime rate, and then you adjust it for risk. And then you could go and compare, what similar listed entities are using in such a case, and do like a risk adjustment on that. It's going to be very difficult to get a specific rate. You can also ask your bank to provide a rate, and then you can adjust it for risk based on your understanding of the customer and the customer's credit ratings. So Alan, I hope I've answered your question there. All right, just moving on. So step 5. So the principle here is, again, you need to go and recognize revenue when you satisfy the performance obligation. And the certification of the performance obligation is all about when the customer obtains control of that asset that you are transferring. It can be a service, it can be an inventory item, but the moment the customer obtains control, that's when you do recognize it from your end and take it over to the customer. Okay. And then again, if you look at the definition of control, so control of an asset refers to the ability to direct use of or obtain substantially all of the remaining benefits from the asset. Okay, so the ability to direct the use of the asset. So the moment the customer can direct the use of the asset and use it according to his preferences, that's when control actually happens. Okay, but it can also include the ability to prevent others from gaining benefits from using that asset. Okay. So important principle here is that, if we test for control, you first test if the control will be over time, and if it's not over time, then it will be at a point in time. Okay, very important. And then if I speak to Anthony's questions earlier regarding revenue, how would you determine, when you have a service, how would you determine the control? So it's actually quite simple. So they simplified it, and they say that if you have a pure service, so let's say a cleaning service or a security service that you provide as a company, you will basically, what the principle there is that as you are performing that service, the customer simultaneously receives and consumes a benefit. Okay. And how you would test for that is that you would go and say, okay, let's say I did the security service for January. All right, and someone else comes in February. They don't need to go and redo the January security work, okay, which means that service has already been consumed, which means then that is a pure service. Okay, so that's the test for a pure service, and that will be over time. So it will basically be treated as a service, similar to IS 18 or the section 23 of the SME standard, where you would do it at a stage of completion based on, fact patterns that's faithfully represented. Okay. Then the second one is when you create or enhance an asset. So that's like a construction company. And the key thing is that the customer controls the asset as it's being enhanced. So that's when you build an office building on a piece of land that's owned by the entity, the customer. And then in that case, it would be also over time. So it's like a normal construction contract. And then the last one is a more tricky one. So when you have an asset with no alternative use to the entity, so when you have a situation where you have a legal opinion, and that legal opinion is tailor-made for a particular customer, all right, you can't go and sell it to another customer. All right, so that's the first one. So you don't have an alternative use to the entity. All right, it's not like inventory that you can just use and resell and reuse. Okay, so that's the first one. So if you have a situation like that, but you also have an enforceable right to payment for performance of work that you've done, then you can also recognize over time. Okay, so it's a very specialized type of product, all right, that you don't have alternative use. So it's tailor-made, custom-made for a customer, and you don't have alternative use, but you also have a right to performance payment. And in that case, you can have over time recognition. Okay. Okay, so just to talk about that. So obviously, if you don't meet the criteria for overtime, you can then recognize at a point in time. And then you look at the risk and rewards, who uses the asset, who's accepted the asset, who's got physical possession, etc. Okay, but let's just take a step back again on the progress of completion then. Okay, so if you are recognizing overtime, you need to go and recognize revenue over time using a method that best reflects the progress towards satisfying the performance obligation. Okay, so what you need to do is you need to go and say, okay, how will I measure my performance on this contract? Will I use outputs or will I use inputs? So in terms of outputs, that again, something that the construction companies are used, certified completion certificates, engineering certificates, units produced, etc. Okay, so that's the first point. So outputs, things that you already provided to the customer and that they can hold value to. Okay. The second way of doing it is using inputs, and that will be the cost incurred into a particular contract. So if there's a budget in terms of a construction company, once again, 1 million rand, and you incur 500,000 rand, it means that you're 50% completed. Okay. It could be hours spent on a particular contract in terms of the budget. So again, it's what you put in and not what you get out of it in that case. So you've got input methods and output methods. And again, in terms of simplifications, for IFRS for SMEs would include a list of methods that's frequently used by entities. So again, here, I just gave examples. So what the standard will then do is that, they will give specific examples of how it is used and the most frequent ones that have been used by other preparers. Okay, just to assist with guidance on this particular matter. Okay, so just a quick example on the progress of completion. Okay, so we've got Brico Limited entered into a contract with the customer to build an office building. The contract starts on 1 January 2020 and is expected to last until the end of 2022. So it's 2 years. So 31 December year end. The transaction price is 10 million. And they've got a certain milestones here. So they've got design and planning, and they've got 10% completion if that is done. Structural certification 80%, and the final sign-off is 100%. And here you can see that the date that have achieved it is on 15 March, which means that they can have a 10% recognition there. And then there's also payments that are due based on each stage. Okay. So by 31 December, the actual cost incurred to fulfill the contract was 3.4 million. Okay, so they give some actual cost there and compare that to the budgeted cost. Okay, and then they say the costs are managed in such a way that it's deemed recoverable at any point in time. Okay, so important is that you need to go and journalize the transactions, okay, either using either using the input method or the output method, okay. But importantly also to say, like, okay, by the 31 December 2020, the COVID-19 impact made it impossible to determine the outcome of the project, what happens in that case. But by 31 December 2020, if all uncertainty was cleared, and the initial estimations will still appropriate. Okay, so we're going to do 2 sets of journals, and just to show the implications there. Okay, good. So in event A, what will happen is that on 15 March, you cannot go and determine the outcome of the contract. So you receive the cash and you create the contract liability, all right, because there's still a sense of work that needs to be performed on the 15th of March. Okay, but on 31 December, what you can do then is you can go and recognize the revenue based on the cost that you've incurred. Okay, so what happens then on 31 December 2020, if you're still uncertain, you can at least recover your costs based on the information that they said. So then what the standard says, you can recognize up until the cost that you've incurred, which is the 3.4 million. Okay, if I just go back one slide. Okay, there they said the 3.4 million. Okay. And then obviously you reverse your contract liability and recognize revenue, but also have a contract asset for the part that you haven't invoiced yet. Okay, so that's not trade receivables, it's a contract asset at that point in time. Okay, good. So let's have a look at event B. So in event B, let's just go back there. They say if all uncertainty was clear and the initial estimations were still appropriate. Okay. All right, so let's have a look. So on 15 March, once again, you debit the bank, you create the loyalty, the contract liability, all right, because you haven't performed, you haven't recognized revenue yet. But then on 31 December, what can you go and recognize? You can recognize, if you use the input method, you can go and recognize the 4.25 million. Okay, which is the 10 million times the 3.4 million divided by the total budget cost of 8 million. Okay, and this is an example where the input method would be quite appropriate because there's a significant length of time between phases in the contract. Okay, so in this case, you have revenue recognized at 4.25, you have your contract liability reversed, and you recognize a contract asset of 3.25. Okay, so the problem here with the percentage of completion, all right, and the milestones. So you can see there that you've got 10% there, which was met in 15 March 2020. However, you are uncertain of, what will happen. You don't know where you are in terms of the 80%. Okay, because there's no specific milestone in between. So what makes it difficult then is to go and estimate what the output would be. You can't go and say it's 80% because you're not there yet, but you can also not say 10%. So then you need to go and estimate where you are. And then, you know, it will be very difficult to justify. So that's a very, you know, a good pro for the input method, which gives you a more reliable way of looking at it. But it also means that, you know, you're looking at the cost that you put in and not necessarily the performance on the customer, to the customer. All right. And then finally, just to talk again about at a point in time. So at a point in time, you look at certain indicators. So in the IFRS 15 standard, they've got a couple of indicators, 5 of them that you need to assess when assessing a point in time. And the first one is that if the customer has a present obligation to pay you, then it indicates that there's a control. Also, if the customer has physical possession, if he has legal title, risk and rewards of ownership, and if they have accepted the asset. So, and again, it's not if one is met, it must be there. You need to go and apply some judgment in terms of when control has actually been transferred over. All right. And I think that is it. I want to say thank you to everybody for listening in. And I went over time a little bit, yes, so apologies for that. And if you have any questions, please feel free to ask, and I will quickly go through it. And yeah, I see they are.
You can email. If you've got questions, I can email Danny, and then we'll pass them on to you. Or
yeah, perfect. Okay. Yeah, okay. I see there aren't any questions yet, but yeah, if there are any questions, you can just email me. I'll reply to you. And yeah, then we'll take it from there. So okay. You know, the session was quite, you know, in a certain sense, maybe a bit premature, but it's almost just there to give you guys a sense of where things might be going. It's not cast in stone yet, but it gives you a direction of where you might find yourself in 5 years' time or 3 years' time. Then okay, the only other thing, I just want to quickly talk about the repeat of the joint ventures. So I just want to quickly just talk about that. So maybe Mervyn just can give me a bit more, you know, specific what exactly he wants to hear there. I can just quickly go back to the slides. I just want to quickly go to that part. Yeah, so for joint ventures, actually not a lot happening there. So if I can just quickly just talk about it again. So it's just a definition that they've changed. And yeah, it's actually won't change the how you would treat joint ventures or joint operations. The only other thing that they've added basically, or they propose to add, is that the accounting for the joint operation when no joint control exists. So if you have an asset where you've got a contract, but that you can't determine that there's joint control, that you can still basically go and account on a proportionate share basis. Okay, so even though you can't determine joint control, you can still say, okay, based on the contract, I've got 40% in this asset, so I would only recognize 40% of this asset and not the full 100%. Okay, so that's basically it for joint ventures. All right. Any other questions? I know, you know, it's getting late and everybody's tired and want to knock off. So if there's any questions, please let me know. And Stan, Danny, if you have anything from your side that's coming through maybe later today or tomorrow morning, please let me know.
Okay, so firstly, thanks everybody for participating, and thank you, Milan, for your insight. Just a quick story. My granddaughter, I took my grandchildren out for some ice creams, and my granddaughter saw a picture on the wall of the chocolate milkshake that she wanted. And then she said to me, she was 8 years old, she said, "Grandpa, do you think expectation will meet reality?" And so the reality is that the next building contract, according to what you're saying, the next building contract that is on time and on budget will be the first. So best apply the rules and go along with this process. So thank you again. Your certificates are ready, everyone, for delivery. And there is another session tomorrow on the general update on IFRS. And so as soon as you join in us at 2 o'clock tomorrow, we'll continue. And again, thank you, Danny, and thank you, Milan.
Thank you, everyone.
Perfect. Thank you, everybody.